Soft landing optimism drives stocks higher. Live from Studio 2 in Bloomberg World Headquarters in New York, I'm Scarlett Fu.
Happy Reddit Day, by the way. I feel like
Is it happy, though?
I don't know. It was happy like an hour ago.
There you go.
Happy 1 hour ago Reddit Day. I'm Castilla. We're kicking you off to the closing bell right here in the U.S. Record high, record high, record high. You got the S&P record high. You also have a SocGen upgrading their year-end target to 5,500. That's the biggest bull on the street. And it's the industrial sector that's really leading the way, up by about 1%. Want to track Reddit? It's up 38%. I get that. But if you look at an intraday chart, you can definitely see the fade in the market. And the Bloomberg Dollar Index up by 0.4%. But it's interesting the why. You got the Swissy lower. You have the pound lower. All as you get sort of more dovish conversations over in Europe. The S&P actually cutting rates. That was really interesting earlier in the morning, and all leading to that dollar strength. But Scarlett, it's just record high after record high.
Well, let's continue with what you're saying about Reddit, because it makes its debut finally 2+ years after the social media site began making plans to list on the stock exchange. We see the stock open up 38%. It then climbed to as high as $57.80 compared with the IPO price of $34. And of course, there's an artificial intelligence link. Reddit plans to license data to AI companies to train large language models. Now, speaking of tech, we are seeing a disruption, or dispersion, I should say, in the sector. Micron leading chip makers higher on demand for AI products, while Apple enters a correction, down 12% since mid-December. The Justice Department and 16 attorneys general sued the iPhone maker for antitrust violations. Now, despite that, the overall stock market is powering higher. Would you say record?
Record.
All right. Well, the S&P 500 headed for its 20th record close this year, thanks in part to data like existing home sales, Alex, that validates the bullish case that the strong economy will keep profits up.
Also, you had those PMIs, and we talked to Chris Williamson on radio, who does the PMI data, and he was saying that, look, we're seeing strength in manufacturing, now coming at the expense of services. So the manufacturing side, the good side, picking back up, as services actually wind up slowing. Okay, so this was my point. Record high after record high. White line, S&P. Blue line is the Russell 2000. The S&P equal weighted index is the yellow line. Now, the Russell is not at a record high. It's at the highest level that we've seen since 2022, but it's what we've seen just in the last couple days that really matters. The Russell 2000 is actually now outperforming the equal weighted index as well as the S&P. Just last week, we were really worried about the weakness in the Russell, saying, oh, look, they outperformed in February, and then now we're going down again. But can the Russell 2000 really pick up steam? Can the rally broaden out? Can other parts of the market pick up the weight from things like Apple, as you said, Scarlett, in a correction?
Well said, and those are all questions we will pose to Kate Moore, head of thematic strategy over at Blackrock. She joins us now as we kick off the close. Kate, is this really the everything rally, or is it kind of just the everything rally today?
I think people are so tired of the leadership last year that they've come out with this narrative that we need to broaden out the market, that we're going to have an everything rally. But not all of these stocks, not all of these stories, not all of these narratives are created equal. And as much as I would like to see every part of the market rise without any pause, I still think we need to be really focused on cash flow generation, on whether or not people have confidence in the business model and the management team. And that's really going to drive, I think, enthusiasm and sentiment over the course of this year. So combined with earnings, which are still going to be a major focus for all fundamental investors, now that we don't have to worry as much about the Fed, and we know that we're on the path to policy easing, I just think the biggest winners are going to be the biggest growers, and we're not just going to broaden out for the sake of rotation.
Is that AI? Is that what you're saying?
It's hard not to love AI, but AI adjacent themes as well. You know, there are a lot of enablers in the software space. Obviously, we've taken a good look at a lot of the data centers and other companies and industries that kind of enable the AI revolution. And of course, we're focusing really hard on those companies that own the data in each of their industries, because they're going to be the winners. So it's not just a couple AI names, but I think it's a broader group of companies that are going to benefit from the significant technological disruption.
What about the big tech names that aren't as intimately involved in AI? And here I'm thinking about names like Apple or even Tesla, which has its own issues with having to cut prices of its vehicles. Is Apple worrisome in terms of the dominance of the Mag 7?
Look, here's what I would say. If you don't have a really compelling idiosyncratic story, which I would suggest Apple and Tesla may not have at this moment, you're not going to get a lot of investor attention. And no one wants to put dollars to work in things that don't have strong revenue growth prospects. And as I was saying, don't have the business models and the management teams that are gaining a lot of confidence. You know, I have to say, incremental money that we're putting to work now are in companies where we think the cash flow is going to continue to accelerate over the course of the year. And I'm not as confident that those are the names, those ones we just talked about, that should gain the investor attention.
What did you make of the DOJ coming after Apple? Like, is that an Apple story, you think, or does all tech need to worry? Like, what do you make of that?
It's a hard question, and I will say Europe usually leads a lot on the regulation side, particularly in technology.
Yeah.
So we think about kind of the focus on, data privacy. We think about the focus on monopoly or anti-monopolistic behavior. And at this point, I'm not sure. I haven't studied enough the DOJ's commentary to say. What I will note is that whenever companies become dominant in their industry, they do get regulator attention. And Europe in particular, as I said, usually leads the charge there.
Well, Scar, we were talking about before we got on air that, like, at what point do the AI plays get so big that then that draws the attention from DC to them, for example?
That's a good question. Kate, how do you think about that?
Yeah, it is a very good question because, we don't want to be so dependent on a single company. We've seen actually the government, like the U.S. government, do this a couple times. They will say, we're going to award a software license or a contract to a specific company and then realize that creates concentration risk for them. And I think they want to see other companies and other clients kind of do the same thing, which is to say, we're going to diversify across a number of different names. Actually, as an investor, that provides more opportunity. That means you don't just have to bank on the one winner in each part of the AI vertical, that you can own a couple different names that are all going to be geared in each part of the vertical.
Is it too early to worry about political disruption from the November election? If there's a new administration coming in, all the things that are in place right now could change on a dime.
Well, a lot of things could change on time, Scarlett. You're totally right. And one of the things I worry most about in 2024 is that companies sometimes pull back on their capital expenditure in the second half of the year going into a big presidential election or a big potential change in leadership. But I would say more than just the presidential election, I'm really focused on the Congress. Like what happens in the Senate and the House, because those are the composition of those can really move the needle on legislation and on regulation and policy. So there's a lot to watch, and I think it's possible you see a little bit of a pause in enthusiasm as the election season heats up.
What is your strongest conviction right now?
I mean, outside of technology and the AI adjacent things. My strongest conviction is that the U.S. economy is in really good shape. I mean, we were never in the landing camp at all last year. We were kind of outliers in that camp. Maybe Goldman was also sort of in that space as well. But I think there is a good strength across a lot of different parts of the consumer that may be a little under-recognized. And as some of the input costs come down, we're like highly convicted in the disinflationary trends. I think that's going to be good for margins across a whole bunch of the consumer. So I'm looking for opportunities there. We have a modest overweight to consumer discretionary in specific areas and specific names. But I think that's going to be an area for us to add to risk.
What's the one thing you're worried about that you can't get out of your head, even though the signs are still pretty solid?
The one thing I'm very worried about, actually, is around politics and geopolitics. And as I mentioned, it has an impact on spending decisions. But of course, it's not just the U.S. elections. We have elections all around the world. There's a significant number of geopolitical risks, which may not, over the long term, affect the price direction of the market, but it can affect investment decisions. So I worry about that being a cooling force when everything else looks pretty good. Disinflation, monetary policy easing throughout some part of this year, the consumer in healthy shape, and this awesome shock and discontinuous change from technology. But if everyone gets a little bit worried, and CEOs and CFOs are people too, and it pulls back on spending, that could be an artificial pause to economic growth.
Right, got it. Kate,
looking at it.
Really appreciate your joining us today.
Yeah, thanks
Kate
so much
Moore
for
is
having
head of
me.
thematic strategy over at Blackrock, and we love it when she joins us here
Love it.
in studio. All right, coming up, we were talking about this earlier. Shares of Reddit soaring as the social media platform raises almost $750 million. It is one of the most highly anticipated IPOs of the year.
All right, plus you got Nike reporting after the close. We'll get a preview of what to watch and what the numbers might indicate about the health of the global consumer.
And big tech under fire. Alphabet and Apple set to face major investigations by the European Union, while in the U.S., the DOJ hitting Apple with an antitrust suit. We will dig into all of that next. This is The Close on Bloomberg.
It's been our dream to have our users and our communities to be able to be shareholders in Reddit. Everything on Reddit is built by our users and communities, so having them be owners makes a lot of sense, and we're so excited about that.
That was Reddit Chief Operating Officer Jen Wong speaking earlier from the New York Stock Exchange. All right, so shares opening 38% above its $34 IPO price and its trading debut. I do want to point out, though, look at the stock and the chart. It has faded a bit. Granted, we're still trading at 49. Bloomberg's Bailey Lipschultz and Bloomberg opinion columnist Dave Lee join us now. All right, Bailey, your take. Was this a success?
It was a roaring success, and I think it was a surprising success.
Do we care that it's fading now, though?
Maybe. I don't know. I think that the interesting thing is when you look at the value traded, so it's north of $2 billion of value. It's already traded the float 1.5 times. More volume, more value traded than Astera Labs had yesterday, which has since doubled from its IPO price. So it does seem like the animal spirits are maybe not back in full force, but it does seem like investor enthusiasm and excitement is percolating. All
right, Dave, what say you? Success?
Yes, I agree with Bailey. I think a success today, but I think, ultimately, we're going to see whether Reddit's IPO is successful, not today, but long into the future when it starts to answer some of those questions about its advertising model and whether it can sell enough data to turn around its losses at the moment. But as far as a first day goes, yes, I think everyone at Reddit is going to be very, very pleased with what's happened.
Everyone at Reddit. So who's everyone at Reddit? Because you could say it's management and the company, or you could say it's the community. And one thing you point out, Dave, in one of your recent columns is that one of the risk factors that Reddit included in its prospectus was its user base, that they're kind of fickle and they can turn on the company.
Yes, I had to laugh when those risk factors were first published. They were enormous, hundreds and hundreds of words, much longer than risk factors from Facebook and from Twitter when they went public. And that's because Reddit is a unique social network. It relies very much on volunteers to moderate its content. There's 60,000 volunteer moderators that help run Reddit's site. But also it has users that can band together against the site or against a stock, as we saw from the Wall Street Bets fiasco involving GameStop and other meme stocks as they become known. So this is a really interesting case of where a user base has such control potentially over the success of Reddit long term. Yeah. And I have to say, there seems to be a lot of apprehension among not just moderators, but most users on Reddit, wondering, how will the stress of being on Wall Street change the nature of this company and how it has to make money?
Bailey, this is really meta that Reddit users are on Reddit talking about this, wondering about this, and maybe even discussing whether they should short the stock.
Well, that was the popular take, Scarlett, initially when the S1 flipped was like, oh, we can't wait to short it. We hate it. I talked to a pair of mods who manage the Wall Street Bets account, and they both kind of shrugged it off and said their vocal trend is to be critical of the company. That's in vogue. That's how you get upvotes. You don't get upvotes and good karma from other users by being pro Reddit. And that's really one of the interesting things and kind of has been something we've been tracking since the meme stock mania of 21.
Do we know if the Reddit users are buying the stock today?
We know that they got an 8% allocation, so
right.
8% of the shares were allocated to moderators and users with so-called high karma scores, which means you're just very active and get those upvotes. We will be interesting to see how some of the data points come out. Fidelity is one of those that publishes some of their daily trading volumes from their retail clients. But when you're the top-ranked ticker mentioned on StockTwits, on Reddit itself, on Wall Street Bets, that does seem to indicate that there is some appetite.
Hey, Dave. Do you get the feel, you mentioned profitability, right? They have to deliver on that. Do they, though? Like, if it's going to be a third derivative AI play with their data, basically, do they need to be profitable at that point?
I mean, look, if this is a company going public at the same time as the other social networks did, then profitability wasn't as much of a concern as I think it is now. I think the company hasn't made money. It made a loss of, I believe, $91 million last year. I think investors do want to see profitability, even on these new JVs, perhaps more soon than they did in the past. Obviously, companies like Uber were able to go losing money for a long time. That doesn't seem to be the state of play now. And I think where Reddit has these big question marks over is sort of questioning how valuable its data might be, because you have a company here that has reams and reams of conversations, of links, of people talking in natural language, which is very valuable. But whether it can monetize that to the degree that investors might want is going to be tricky. And can it do that in a way that doesn't upset the users that, as we've discussed, can be pretty volatile at times?
Yeah, those large language models will learn a lot of acronyms for sure. Bloomberg's Dave Lee and Billy Lipschultz joining us for a roundtable on Reddit. I don't know about you, but when I look at Reddit, it feels like it's very much a relic of the early 2000s. It doesn't look like a social media site that you use in 2024.
Well, I mean, it was from 18 years ago.
I know. The design, though, I'm just
that.
saying it hasn't been updated,
But I don't know. The users don't seem to care.
I
mean, they have so much engagement at that point, too. I just wonder what is our takeaway from this week in terms of Astera and then Reddit, right? Like, is the IPO market open? Are we ready? Or is it a bubble? Or were these one-offs? Or is it all still some kind of AI derivative play?
It's an AI derivative play. Astera is definitely an AI. It's not
That's
derivative.
for sure. That is it.
Right,
yeah.
That is it. This is AI derivative for now. We'll see how far they get with this. This is a story we'll figure out in about 6 months or 6 years. Coming up, Nike at risk of losing fans on Wall Street. We've got more on the pressure facing the retailer's earnings release after the bell in today's Top Calls. This is The Close. Time now for our top calls. A look at some of the big analyst movers on the back of analyst recommendations. There we go. We're going to start with Adobe, the software company getting a rare sell equivalent rating from analysts at KeyBank. The price target set to $445 as the firm starts coverage of the sector. You have the analyst there saying Adobe will be pressured by competition in Gen AI and slower growth in its Creative Cloud suite. While the launch of its Firefly add-on helps shave off some of those threats, the onslaught of text-to-image and video products being released may prove too overwhelming in the end for Adobe. The shares down by 1.75%. Next up, Paramount raised to neutral from sell at Rosenblatt Securities. This after a Bloomberg report that Apollo Global offered to buy Paramount's Hollywood studio for about $11 billion. The analyst says the best value for most and potentially all entertainment conglomerates is to break up sooner rather than later. The shares down about 5%. And finally, Revolve. Carin upgrading the fashion retailer to outperform from market perform. Analyst Oliver Chen says now is the time to buy into a leading Gen Z platform. He expects the company to see margin expansion and a return to sales growth in the second quarter after a year of markdowns and broad-based softness. The stock currently up 0.8%. And those are some of our top calls. Now, staying with retail, Nike is set to release its third quarter report in about an hour's time, and one big area of focus for investors is the brand's performance in North America and China. Joining us now for a preview is Zach Waring, equity analyst at CFRA. He's got a sell rating on the stock. So, Zach, when it comes to Nike, yes, the performance domestically, yes, the performance in China, and the cost cuts are of huge concern. Is there a growth story here for Nike in the short term?
Yeah, thanks for having me. So, I mean, that's what we're looking for. We're waiting for management to tell us where their next leg of growth is going to come from because, it's been kind of stale over the past 2 or 3 years. China hasn't really turned out how they liked it and how analysts want it to turn out. They haven't seen sales, recover to 2021 levels yet. And so, it's what we're looking for management. We think analyst expectations for next year are a little bit high at $4.20 in EPS in fiscal 25. So, yeah, I mean, it's going to come down to what management thinks is the next leg for them.
So, Zachary, Andrea Felstead is a Bloomberg opinion columnist, and she had a great piece out that talked about Adidas versus Nike and how Adidas is kind of getting wise to how they should be running things, right? You don't need the next hot thing. You need a consistent product, which is what like a Lululemon has, for example, or even Dick's Sporting Goods. Do you feel like Nike is going to do that?
Yeah, so, we're actually a little bit worried about their competition. You've seen some of these newer sneaker brands, Hoka and On, kind of take over and seen really significant growth and market share gain over the past year or two. And we think that's going to continue. And I think Nike's been a little bit complacent. And, Adidas is, another mature brand that's been around for a really long time. They're global. And they're starting to see some competitors come, out of the woodwork. So, I don't think that's really a good play moving forward. You're seeing this competition. Adidas obviously is global, and they've saturated a couple of their markets like Europe and US. So, yeah, I think that's probably not the way to play it moving forward.
Well, Nike did beat out Adidas in terms of sponsoring the German national soccer team, so there is that where it's expanding in Europe. You mentioned in your note that the Jordan brand is doing really well for Nike. Can you explain a little bit more about how the Jordan brand works? I know that the movie Air came out and that got everyone all excited and kind of reminiscent on Michael Jordan, but what are the growth prospects of a brand featuring a player that's not in the NBA?
Yeah, it's his legacy brand. Obviously, Michael Jordan, one of the greatest basketball players of all time. They came out with that movie last year, and they saw a sales boost from it. I think it's more of they're stealing from themselves in terms of market share there in the U.S. So they're going to look outside of the U.S. for the Jordan brand to grow. The Nike brand has saturated the U.S. market across the board in terms of running shoes and basketball shoes. And so, the Jordan brand grows, but it's taken market share from itself, from its other basketball shoes. And so you're gonna really have to look outside of the U.S. for that brand to grow more, which they've done, and they've done a good job over the past few quarters. So, we think it's got to come from somewhere else from Nike, and we're just not sure where that's going to be. So that's kind of where our call is coming from.
Before we let you go, what would be a good considering all of this backdrop? What would be a good operating margin that they were able to manage their wages and their promotions, etc.?
Yeah, so we think this quarter is going to be pretty strong. We don't think they're going to miss by any means. Analysts have brought their expectations down pretty drastically, and actually they think EPS is going to shrink year over year. So, we think they're seeing a lot of tailwinds from freight, like other retailers, and less promotional activity. So, we think 13%. Plus, it's probably a good number here in terms of operating margin, and we think they'll achieve that. They usually do a pretty good job of leading investors and analysts lower and then beating. So, we're not really worried about the quarter. We think it's more in terms of growth outlook for the next 12 months.
Yeah, and that stock down, almost 18% since that high in December. All right, Zachary, thanks a lot. Zachary Waring over at CFRA joining us there. I feel like you're a Nike person.
I've been looking at high top sneakers, and there are a lot of women wearing the Jordan high tops, and I don't know whether I want to dip my toe into that and spend that kind of money, but the colors are kind of nice.
So her answer to me was yes.
No, yes, it's a very nuanced answer.
Yes, she is. All right, fair enough. All right, come on. We're going to talk to Jill Castilla, President and CEO of Citizens Bank of Edmond. This is Bloomberg.
It's just about 3:30 p.m. in New York. This is the Countdown to the Close. I'm Scarlett Fu.
And I'm Alex Steele. So I just want to take us back to the PMI that I mentioned earlier. So manufacturing actually is doing better. Mm-hmm. And Chris Williamson of S&P Global was saying that the economy, the numbers are looking at a 2% economy. That's super solid. And that manufacturing is actually doing a bit better at the expense of services, which is kind of what we wanted to see anyway, but prices continue to rise.
Yeah, that's the tricky part, right?
Yep.
Because, you want to see the economy doing well, but you want to continue to see that disinflation. And, Jay Powell had warned there'd be bumps in the road. This is yet another bump in the road.
Nevertheless, I mentioned earlier, the industrial's best performing sector within the S&P, financial's best performing sector in the S&P also over the past month, third best performing stocks so far this year. Like the big banks are still doing really well, which says a lot about growth. The road, though, for regional banks Speaking of bumpy, could be bumpy this year. The KBW Regional Banking Index is down more than 8%. And the FDIC is proposing some new rules that could make bank mergers even tougher. We kind of been waiting for that to be a trigger and a catalyst for regional banks. Maybe that just got harder. So the rules would take financial stability into account, along with the effect on communities and the impact on competition, adding layers of scrutiny to the merger process. It would be for a bank that would be combined with more than $100 billion in assets. Well, joining us now for more perspective and her take on the economy is Jill Castilla, President and CEO of Citizens Bank of Edmond. It's a community bank located in Edmond, Oklahoma, and it's one of only 14 women-led banks in the U.S. Thank you for joining us, Jill. We really appreciate it.
It's great to be here. Thank you.
So I just get confused about the overall regional banks. On the one hand, I feel like, oh, there's too many. You guys all got to consolidate. On the other hand, and the FDIC is like, nah, maybe not so much. We're going to look at it closer scrutiny of it. What do you think?
Yeah, it's interesting. We're a small bank, so 4,000 banks are kind of like us, where they're under $1 billion. And this is really focused on those large regionals. And they run into a lot of issues when you start stretching out that M&A activity and the approval process, cybersecurity issues, retaining talent. I don't think that's not very good for the economy or nor toward the financial stability. So yeah, I think this information we got today from the FDIC, I don't know what the unintended consequences are going to be. So it'll be interesting as it's all kind of vetted out.
It's like a flashing yellow light as opposed to red light or green light, right? So people say that the U.S. is overbanked, and yes, it's usually in the context of those regional banks. When it comes to the community banks, the smaller banks, do you get the sense that the U.S. is overbanked?
I mean, when you look at it, when you look at my suburb, there's 60 different banks. And so it looks like from outside, like, wow, this is a lot of banks in one place. But our small community bank, which is one of the smallest in the area, 122 years old, serves those that don't necessarily fit in at a Bank of America or a larger regional bank. So small business owners that need a lot of time. I'll spend 3 years with someone to get them bankable. And that just isn't going to occur at a larger institution where you have less maybe like physical kind of investment in the community.
A 3-year investment in talking with them?
So how does that work? So I come to you and I'm like, hey, I want to expand a yoga business, or I want to build a yoga business. And you're like, yes, this is how we can help you do that.
Well, so it might be like, I want to open a restaurant. That's my dream. I'm a great cook. I want to open a restaurant. And then we'll start talking about what are the stages? What does your credit look like? Oh, you have some credit repair. What are some steps we can take to get you where you're credit worthy enough to be?
You're like a financial advisor almost.
Well, you're supposed to, like, bankers have always been kind of these partners where you're like a trusted resource, that you're a steward and you're helping someone really achieve generational success. And so it might be opening that food truck. Maybe that's the first loan rather than getting a huge restaurant. Let's test the market and see what that looks like. And you're really guiding someone to success, and it's incredibly rewarding.
I can imagine that. What are you noticing now? Like, what are some of your clients or prospective clients coming to you and talking to you about?
Yeah, it's starting to normalize. Before, there was just so much money. There was a lot of government assistance related to COVID. And so you didn't have to be as discipline your business plan to get something kind of off the ground. And now we're kind of back to those times where we do see having some business there, having some vulnerabilities, but it's more normal type of vulnerabilities. And so we're helping them through those types of issues. But it's still so incredibly positive. We finished the year with 0 past dues, 0 non-accruals, 0 classified loans. That hasn't happened in my 20-plus year career.
Well, you have the ability to really vet your customer base in a way that perhaps the regionals and the bigger banks don't. I'm curious about interest rates, because obviously we know a lot of people are stocking away money in their savings accounts, enjoying the high yields that they're currently getting. The Federal Reserve has indicated its next move will be a rate cut. Once that happens, how long before banks like yours start to cut the rates that you offer on deposits?
Well, I think you'll see, it just depends really on deposit competition. In some areas of the country, deposit competition is very robust. It is in Oklahoma City.
Okay.
In rural communities, it may be a little bit less than that. So it all depends on what the composition is, because in some areas, you might be able to reduce rates more quickly. We have a really loyal customer base, and so they may be more receptive to that and have less interest rate sensitivity.
So I feel like Silicon Valley Bank, for example, would also have said that they had a very robust and loyal deposit base, which did not pan out. Why are you different? Like, why is a bank like yours actually different? Have you seen any deposit changes?
So they had over 90% uninsured deposits. I have less than 5% uninsured deposits.
Oh, okay. Well,
my median account balance is $12,000 versus millions of dollars. So depositor concentration matters a lot. 120 years of banking multi-generational families, yields a lot of stability. So you're not dependent upon one or two customers or 100 customers, where we've got 20,000 customers in our $350 million bank, which is far more, I would suspect, than what SVB had.
We started our conversation with the FDIC and the government taking steps to kind of get mergers going, or in this case, putting up obstacles to mergers. What is your biggest concern when it comes to the government moves that address the banking sector?
Whenever we increase regulation, it always results in unintended consequences. And for a small community bank, you would think I would have really no dog in the hunt for a $100 billion bank merger and acquisition policy. But it all rolls down to me at some point in time. And so it always makes increased regulation throughout the entire industry whenever we were focusing on large banks. More regulation ends up consequently hurting small businesses and mortgages for Americans trying to buy a home. So if you're increasing the rigor here, it always, because the financing for a lot of those activities happens at those larger institutions, it's a really healthy ecosystem when it works properly. But when you start having a lot of regulation coming down more quickly and not very mindfully, it can cause us unintended consequences that can be severe.
Jill, we love talking to you. That was totally fascinating. Thank you so much. Jill Castilla is president and CEO of Citizens Bank of Edmond. So interesting.
3 years. 3 years.
I just can't imagine like that ever happening in like, I don't know, maybe it does, but like walking into a main big bank in
Chase or Bank of America are not talking to me for 3 years.
I mean, maybe in certain areas, but I don't want to discount it altogether. But that's quite interesting. It's sort of like a longer term investment in that way. And I have a friend who's a small business owner, and she's trying to come up with some kind of plan to expand, but then she needs a way to like bridge that, right? She needs a way to get to expansion to profitability, and she's like doing it on her own spreadsheet, you know?
Yeah. Well, maybe she needs to find a community bank. That's the lesson here.
In Ditmas. All right, coming up, it left unchallenged. If left unchallenged, Apple's monopoly, like power in the, I don't know how to read that tease. Apple in the hot seat, the DOJ coming after Apple. We'll break it down. This is Bloomberg.
That was
We allege that Apple has employed a strategy that relies on exclusionary, anti-competitive conduct that hurts both consumers and developers. For consumers, that has meant fewer choices, higher prices and fees, lower quality smartphones, apps, and accessories, and less innovation from Apple and its competitors.
That was Attorney General Merrick Garland speaking earlier about the DOJ suit against Apple, basically accusing the iPhone maker of monopolizing the smartphone market. Apple also facing antitrust allegations in other markets like Europe. If you look at the shares, they are currently down right now, $7.72 at $170 and change. And in fact, since mid-December, its most recent high, it's now lost 13%, putting it in correction mode. Joining us now for more in our Stock of the Hour is Jennifer Rhee. She's senior litigation analyst for Bloomberg Opinion. Intelligence, pardon me. Jennifer, it's been several years since it became public knowledge that the DOJ was looking into Apple, and we have long heard speculation that there was going to be some kind of suit. Why now?
Well, you know, we knew a few years ago that the DOJ had opened investigations into Google and Apple. And I think really what happened here is that it just focused on Google first. I mean, we know right now there are 2 pending DOJ monopolization suits against Google. It takes a lot of time and resources to develop those suits and bring those suits and then litigate them. And I think they really did want to eventually get to Apple. And I think that they needed to do it now because obviously we have an election coming up and it's possible there could be an administration change. And the enforcers, the decision makers could be changed. So if they wanted to get this suit in, now was the time to do it.
What do you think the result of this is going to be, Jen? Because I really struggle with the why behind it. Because many people would be like, hey, I like it the way it is. It's easier. It's one-stop shop. What's the problem?
And that's what Apple's defense will be, at least part of it. You know, Alex, it's so hard to say because here's the thing with monopolization suits. It's all about the conduct. And the conduct the company engages in is only illegal if it's deemed to weigh more harmful than beneficial, right? So first thing the DOJ has to do is show that this conduct has caused harm. But the next thing is Apple can defend it by saying, look, this conduct might have caused a little bit of harm, but we have pro-competitive, legitimate business justifications for our conduct. And I actually think they have some good ones, by the way. And those outweigh this minimal harm that you're talking about, DOJ. And when that happens, you lose. And I think that's why it's so hard to say, because all of that depends on the facts and depends on the evidence. It depends on what's in the documents. And when Apple, let's say, engaged in certain policies and conduct and rules that the DOJ is talking about, what was the intent behind those and why did they?
Right. So it's in the eye of the beholder, certainly. Jen, what kind of remedies are the DOJ and the state seeking?
Well, not structural. They haven't been literal about that like they have been in the complaints against Google, where they specifically say they're seeking an injunction that's going to break parts of the business. They're really looking for forced interoperability here. They really want to break open Apple's walled garden and make it so that Apple's hardware works with non-Apple smartphones, and the Apple smartphones work with non-Apple hardware. Let's say the Apple Watch, for instance, or other fitness watches working better with Apple with an iOS. And they're saying that these things, Apple restricts all this now because they want to lock users into the iOS, make it harder for them to switch, and maintain their monopolies, which allows them to charge very high fees.
Jen, thanks so much. You are one-stop shop when it comes to anything antitrust. Really appreciate it. Jen Rhee of Bloomberg Intelligence. What I find interesting is she's talking about harming, right? But harm who? Is it the consumers or is it
Well, if you're an app developer, it might hurt you because Apple charges that hefty toll of 30% commission on everything. Epic Games, the maker of Fortnite, would allege that was harmful. For you and me, I don't think it matters all that much, unless you're an app developer in your spare time.
I 100% am not. But I also wonder, too, then does it hurt their ability to become like a services company, which is what they keep saying they want to do because their margins are so good? If that margin shrinks, then they just really have to rely on being a hardware company, and does that come with problems?
It probably does.
Hence the stock price down 13% in just a couple months. All right, coming up, we're going to continue to count you down to the closing bells with Carin, head of portfolio management over at Fiduciary Trust International. This is The Close on Bloomberg.
This is the countdown to the close. I'm Scarlett Fu here with Alex Steele. Record high, record high, record high.
That's literally the board I was going to show you. S&P record high. S&P equal weighted record high. The Nasdaq 100 record high. Russell 2000 not at a record high, but it's still at the highest level we've seen since 2022. We were talking about earlier that, I feel like on last Thursday, it was like, oh man, the small caps did not break out. It's over now. We're just going to go back to big tech, and look at that. Now we're seeing them outperform.
We have to take it on a day-by-day basis. And for today, there is a breakout. There is a broadening of the advance. Well, as we mentioned, the S&P 500 set another record close, or is on course for a record close today. We spoke earlier with Kate Moore of Blackrock, and she gave us her view on just how far this advance can go.
I think people are so tired of the leadership last year that they've come out with this narrative that we need to broaden out the market, that we're going to have an everything rally. But not all of these stocks, not all these stories, not all of these narratives are created equal. And as much as I would like to see every part of the market rise without any pause, I still think we need to be really focused on cash flow generation, on whether or not people have confidence in the business model and the management team. And that's really going to drive, I think, enthusiasm and sentiment over the course of this year. I just think the biggest winners are going to be the biggest growers. And we're not just going to broaden out for the sake of rotation.
For more market analysis, let's bring in now Carin Pei. She's Executive Vice President and Head of Portfolio Management over at Fiduciary Trust International. So we're not going to broaden out for the sake of rotation. Would you agree with that?
I would agree. I think to a certain extent. I do think that, rotations occur in markets based on certain drivers, coming from either bottoms up or top down perspective, right? So if there's a change in dynamic in terms of interest rate expectations or economic growth expectations, I think that will probably determine kind of what type of rotation we'll see.
I mean, and Kate's point also is like, you still have to love tech. Like you can't not love AI. You can't not love tech. Do you? And did we learn anything this week from the IPOs?
Sure. I think it's topic du jour, right? So we do believe in technology. We do believe in owning growth stocks. And if you look at the technology companies, they're the ones that are really generating a lot of the growth behind the S&P 500. But as we were talking about, or as you were talking about earlier, the broadening out in the market, I think that's very positive to see. I think we need that to sustain a market rally. And I think, certainly a market that participates from a catch-up of the rest of the market is better than a market that, sort of consolidates based on a correction from, some of the winners, right? So I do think that, this is a market where earnings growth will be rewarded, but I also believe that it's a good time for investors to really pay attention to valuation and shift into, some income-generating strategies.
So Alex followed up with that question about IPOs. I just want to throw that to you now. We have Reddit, of course, making its trading debut today.
Yes.
Sarah, of course, went public yesterday. Both of them have a link to AI, one more tangential than the other. Are these issuances, do they tell us anything about risk appetite right now? Or are they just, because of AI, they're going to be received well?
I think we are in a risk-on market. I think risk appetite is fairly high. So, seeing the strong performance of Reddit certainly speaks to a favorable environment for IPOs. This also coming off the back of the Fed's comments about, keeping interest rates easy. I think that's also conducive to riskier assets. I do think that in terms of AI and participation, I think we really have to be careful and determine which companies are true beneficiaries versus which ones are hype. So I think everyone loves to kind of bring in the word artificial intelligence or AI, whether they're talking about their business models or whether they're talking about their earnings reports. And we see that stocks are driven to sort of extraordinary levels just by mere mention. So I think we do have to decipher hype versus companies that can actually deliver on a true business model substantiated by AI revenue.
You mentioned, in addition to income-generating strategies, does that mean dividend players? Does that mean treasuries? Does it mean the credit market? What does that mean for you?
Yeah, actually, I would say all of the above. I think that it's a good time for investors to kind of start first from an asset allocation perspective and rebalance. I think that's always a good thing to do in this type of environment when valuations on equities are really, kind of at the richer end. So I think, first of all, I think it is a pretty decent environment for investing in fixed income where there is decent yield. And in addition to that, I do think that this is a good time to shift into income-oriented equities, right? So growth can come from earnings growth, revenue growth, or cash flow growth. And I do think that it's important to kind of look at your portfolio and make sure that there's diversification.
What sectors would those be?
So I do think that there are some good stocks within healthcare and also consumer staples companies. I think that those are two areas where you have some pretty good valuations. But even within technology, there are stocks that are generating income and dividend yield and have dividend growth. So I think that it's definitely a market where it pays attention to be selective.
Just to end on the animal spirit part, it's definitely risk on. Should the market be this risk on? And what would be a sell signal? I'm always skeptical. I'm the kind of person that puts soup cans and gold under my bed. I don't actually do that, but I would if I could. What is going to make me feel better about this rally?
Yes, I think that's a great question. It's a tough market to be in. I really do think that it is a market that sort of keeps us up at night because we've seen some parabolic moves, right, in a short period of time. And, I think that there are some relatively high expectations. So, I think some of the signs that I would, definitely look to are signs from, I think we have to start with the fundamentals. What's the path of the economy? What's the path of interest rates? I think that if there is a gap between market expectations for rate cuts versus the reality, I think consensus right now has 3 rate cuts, sort of priced in. If we don't get that, or if inflation is stickier than what the market expects, I think that could be a risk. And I think, if earnings disappoint, because earnings expectations right now for this year are 11%, right? If there's some disappointment on that front, that could also be a cause for volatility.
All right, Carin Pei, thank you so much. Carin is Executive Vice President and Head of Portfolio Management over at Fiduciary Trust International. I keep thinking about that $6 trillion wall of money that's sitting there that could be put into the market. It hasn't been so far, and as long as stocks keep rising, there's no real incentive to keep chasing prices.
And it does beg the question, like, does it belong anywhere? Or is that just what we would have seen in bank deposits?
Yeah.
And they're just in money markets, and that's just the difference? So they're not actually going to be invested anywhere.
Yeah, people are comfortable with them sitting there.
Yeah.
All right, we're moving closer to the closing bell. Full market coverage begins right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We're about 2 minutes away from the end of the trading day. Scarlett Fu and Alex Steele with you, counting you down to the closing bell. And we're bringing in our colleagues from radio right now, Carol Massar and Tim Stenovic, saying hello to everyone across Bloomberg Television, Bloomberg Radio, and our YouTube audiences. Soft landing hopes spring eternal, Carol.
Well said, well said. You know, I keep looking and I'm thinking, what? Record on the S&P, could be a record on the NASDAQ 100. We have 2 tech IPOs, one yesterday. It's continuing to gain today. Of course, the Reddit IPO up almost 50% as we speak. I'm like, wait, is this 1999? Like, what time is this? Like, it just feels like we were just talking with a guest who kind of was like throwing water on the fire and saying, wait, slow down a little bit. It takes a while for all that Fed interest rate increases to kind of kick in, and we're getting to that environment.
That was Cheryl Smith. She's over at Trillium Asset Management. She's economist and portfolio manager, Alex, and she is a little concerned right now. She says we're 4 to 6 months away from a recession. She started to see softness when it comes to many of the state employee figures. Credit card delinquencies are, are going up. And she says it's always like this just before there's a recession. And it's a really contrarian view that we're hearing right now from her, because it goes against everything that we've heard from so many other participants and market watchers.
Which it just feels like them are just in a bifurcated sort of world, right? That if you have your money invested in money market accounts, like Scarlett and I were just talking about, you're making a nice return. Maybe you're doing okay. If you're in the equity market, you're doing okay. But I think Larry Summers and had a paper out with some colleagues that talked about the fact if you factor in debt in addition to mortgage payments and debt payments, you're actually looking at a lot more stress on the market and individuals than would be implied by just straight up inflationary numbers. All right, there are the closing bells. I think we're at a record. I'm trying to do this real fast, but it seems like we're at a record for the S&P, right? And we're at a record for the equal weighted index as well. The NASDAQ 100 at a record. Here we go, guys, though, record after record.
Yeah, exactly, right? I mean, it just makes you look. I mean, we're looking at what, about a 27% jump in the S&P 500 since that late October level. So we have seen quite a run up. S&P 500, folks, let me just dig a little bit deeper. We've got 379 names to the upside, so a lot of names gaining in today's session. 123 to the downside, Scarlett, and 1 unchanged.
And a very broad advance as well. You look at the IMAP, which of course breaks down the S&P 500 into 11 sectors. Industrials, financials, energy, those are your best performers, but you've got 9 out of 11 groups in the green. The laggards here are utilities and communication services, but industrials take the lead here, up almost 1% on the day.
All right, guys, let me get to some of the individual gainers, if I may. Micron on that list, closing at a record high today, up 14% here. Largest U.S. maker of computer memory chips, soaring today. We know we broke it down yesterday after the close when it gave its quarterly update and outlook. It gave a surprisingly strong revenue forecast for the current quarter, buoyed by demand for artificial intelligence hardware. So this one, definitely an outperformer.
You called it, Carol. You called it yesterday.
Do you know? It was on my list.
She
I
told
put
me
it on there.
She did her gainers before the market even opened this morning. She told me that's a little secret to Carol Massar.
But I mean, it worked.
She was
It worked. All right. So Reddit is on my gainer list today. Of course, we've all been talking about it. IPO today at its highs, up as much as 70%, finishing the day with about a 48% gain, $50.44 a share. Remember, it IPO'd, at 34 a share, which was the high end of the range, and popping in a big way today. I wanted to check just real quickly what the market cap, over $8 billion, according to the Bloomberg terminal. And then let's go to the IPO yesterday, talking about Astera Labs. This one, which gained over 70% yesterday, soaring again in today's session, up about 3%. Actually, it was up much more earlier in the day. So, a little bit of a pop, but nonetheless, gaining again for a second day. Semiconductor connectivity company geared to enabling what is called mainstreaming of AI and machine learning in the cloud. So nonetheless, that one continuing to gain ground in its second day of trading as a publicly held company.
Okay, so Carol does the gainers before the market even opens.
I had the easy.
I'm at 355, frantically finding the companies that actually move lower. There were a few actually prominent ones. We got to start with Apple because shares of the company fell more than 4%. It's actually its biggest drop going all the way back to August. Raised about $114 billion in market cap today. Year to date, Apple shares are down 11%. Regulators on both sides of the Atlantic are taking a look at Apple right now, and that's got investors worried. Here in the U.S., the Justice Department and 16 attorneys general are suing Apple for violating antitrust laws. We spoke to Jen Rhee over at Bloomberg Intelligence, who said this could be a years-long process. In Europe, the company is said to be facing probes about whether it's complying with the Digital Markets Act. So some regulatory concerns on both sides of the Atlantic for Apple. Shares down 4.13% today. And now check out what Accenture said about IT spend this year that had shares moving lower. Shares fell 9.3%. It fell as much as 10%, its biggest intraday drop in more than a decade. You have to go back to June of 2013 to find that. Accenture cut the top end of its adjusted earnings per share guidance for the full year. It missed the average analyst estimates, and the company, which of course does consulting services for IT and tech, warned that it's seen financial services customers pull back their spending when it comes to software. And then Chewy, this company reported after the bell yesterday, shares fell earlier in the session and ended up finishing down more than 10% on the day. It did post net sales guidance for the first quarter that didn't meet consensus estimates. The online pet retailer beat consensus on fourth quarter net sales and adjusted EBITDA. Analysts, though, flagged a sequential decline in active customers during that period. Citi did say the results were good, but not great. Nonetheless,
they need more 20% off coupons.
You think so?
That's the solution.
Their margins must love that.
Their customers love that.
Yeah, that's fair.
That doesn't always work out for the companies, right?
Yeah.
With those discounts.
Yeah. See, you could have done that yesterday, Tim. Maybe you're just, you're not thinking
I
ahead.
couldn't have done Apple.
That's true. That's true.
Okay,
All right.
to be fair.
I'm taking a look at the bond market here, guys. So you're looking at more action in the front end. You're having a little bit of a sell-off there. You have yields up by about 4 basis points, reversing some of the gains that we saw yesterday in the market. Also, just on the macro, bent here, the BOE laying the groundwork for a cut. No one wanted a hike this time round. The S&B wound up cutting rates. So just all across, it feels like, S&B beat the Fed to it, right? So in some ways, it's no surprise that you see higher yields on the front end.
All right, folks, a few more earnings still crossing as we are almost really done with earnings season, but Lululemon crossing. Let's go to the numbers. Fourth quarter EPS, $5.29 a share. Also looking at fourth quarter net revenue of $3.21 billion. Slight beat, guys. The estimate is $3.19 billion. More importantly, let's go to the outlook. First quarter EPS of $2.35 to $2.40. Looking for some comparison here. And also says it sees first quarter net revenue of $2.18 billion to $2.2 billion. The estimate on the street was $2.26 billion. No surprise to see the stock tanking in the aftermarket. Right now down about 7% here. The stock is down 6%, though, in 2024. But again, a drop of about 9% in the after hours.
Yeah, the first quarter revenue is what is coming in light. Analysts were looking for $2.26 billion for the first quarter revenue. Lululemon sees it at most at $2.2 billion. And the first quarter EPS of $2.35 to $2.40. Analysts were looking for $2.55. Are there discounts taking place at Lululemon? Because I go in there a lot and there are not.
I never do discounts.
I know.
That's why I
never
don't
see
shop
anything on the
there.
sales rack.
Yeah.
So,
I'm not seeing a lot in terms of actual color coming from the CEO or CFO in the press release. We'll have to wait to the call to get more. I did see from Megan Frank, the chief financial officer, said that looking ahead, they're going to stay focused on driving the business forward for the near and long term while operating with agility and discipline. She did say that we're still early in our growth strategy and excited for what the future holds.
Yeah, I agree with you. I was reading through the press release also. It just seemed very vague on that front. One more headline here. Lululemon sees their full year guide does not see share buybacks. And remember, it was that net revenue for the first quarter on the high end that kind of fell short of estimates on that.
Yeah, Calvin McDonald, the chief executive officer in the press release, too. I feel like this is interesting when they're talking about kind of opportunities. We are focused on significant opportunities ahead for Lululemon as we navigate the dynamic retail environment. And I feel like when somebody says dynamic retail environment, I'm like, how do you read that? Is it difficult? Is it good for you? Is it not?
It has to be volatile. It's volatile.
Changing.
It's changing, and we're not sure where we fit into that change.
Exactly how I read it.
They do have a history of these successful activations in store, right? The idea of offering something in a store that you can't get by ordering online, like yoga classes and other fitness things. And I'm wondering what the appetite is for that right now.
Maybe we all have enough yoga pants. All I know is I agree with you. They're never on sale, or there's a little sale rack, and it's not inexpensive, right? It's not inexpensive.
Yeah, $100 yoga pants, everyone.
No thanks for something I sweat in. Not happening.
All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We will see you again for the Friday edition of Beyond the Bell. Yahoo! We'll see you same time, same place tomorrow.
Okay, so we have Lululemon shares falling in after hours trading. We're waiting, of course, for competitor Nike to report earnings as well, in addition to FedEx, which actually just came out. So I'm just going to give you the headlines really quickly right here. FedEx third quarter adjusted EPS of $3.86, beating analyst estimates of $3.46. The revenue for the quarter was $21.7 billion, a little bit shy of what analysts had been looking for. And the company narrows its full year earnings outlook range as well. Right now, we're looking at FedEx shares moving higher in after-hours trading. We'll have more on that when the close continues. All right, FedEx has just reported results. Let's get you more of the headlines here. In terms of outlook, FedEx sees the full-year adjusted EPS of $17.25 to $18.25. Previously, it had seen a range of $17 to $18.50. So kind of narrowing that range a little bit here for the full-year outlook. For 2024, revenue, it sees low single-digit percentage decline in sales in the top line year over year. In addition, it has authorized a new buyback program of $5 billion. For the fourth quarter, it has added a $500 million share repurchase program. So there's a lot of moving parts here when it comes to FedEx. Adjusted operating income for the third quarter, $1.36 billion, higher than the consensus estimate of $1.25 billion. Joining us now is Brian Szytel, Senior Managing Director and Partner at the Bahnsen Group. Brian, great to speak with you. I know that you had owned FedEx for about a year, and then you sold out of it, and it's a stock that you still monitor pretty carefully. Just hearing the rundown of today's results, does it validate all the cost cutting that FedEx has taken over the past year?
Yeah, it's definitely a step in the right direction, and it's good to see. And you're right, we were in the name about a year and a half ago, and have now since exited. So it's nice to see some of this coming to fruition. And that's what this is the same narrative. They've got basically a demand-supply imbalance with cost-cutting measures being taken to try to right the ship from an EPS perspective. And you're seeing that in this quarter's earnings numbers start to come through, which is a positive sign.
So you mentioned that you had owned FedEx for about a year. You bought it in 2022, September of 2022, after a big earnings sparked sell-off. You held it for that year. Why did you exit after just 1 year?
Yeah, I mean, it was a big dip on earnings at that particular time. It was down 21% on the day. It's a great American business and a great dividend grower that we wanted to own, and frankly, we've been eyeing for a long time. It's not characteristic of us to exit a name that soon, and it wasn't necessarily because we think that FedEx won't ultimately execute. It's got a great management team in place. Some of these initiatives and cost cutting, like their Drive campaign and their Network 2.0, I do think will pay off. I just think there's a transition time. And so when we got in around 160 and had the shares trade up to 250 within 12 months, with yields back down to below 2% from a dividend perspective, we just felt that capital would be better deployed elsewhere. But again, that wasn't necessarily a vote of no confidence. Yeah. It's more about the time it will take FedEx to get through some of these cost-cutting measures.
Okay, so you look at this as an income play. You mentioned the yield dipping below 2%. It's at 1.9% right now. What would you need to see in terms of yield for you to get back in?
Honestly, for us, there isn't a set number. I mean, if it got north of 2.5 on the dividend yield again, I think it would be of interest to us. Again, we'd love to own it again. And I do think their dividend growth will catch up to where share prices are. The stock isn't expensive here necessarily. It's trading at 15 times. And so all of these cost-cutting measures they're taking that are coming to fruition are reasonably priced into the name. Yeah. We just want to see that dividend CAGR kind of keep kicking in.
Okay, so we keep circling around this. I guess the question for me when it comes to FedEx is, what is the growth story here? Or is it really just at the mercy of these macro headwinds?
Unfortunately, it's in the throes of some of these macro headwinds. It's in a secular declining, competitive market right now. A lot of competition with UPS and others. This is coming off of a post-pandemic kind of unwind at this point, and they're having to sort of get through absorbing what is basically their express business, which is the largest, by far, largest percentage of revenue, with a profit margin of basically 1% or zero. So that's tough to get through without taking some hard measures. They're doing it. It's just taking some time.
All right, Brian Szytel, thank you so much for joining us today. Senior Managing Director and Partner at the Bahnsen Group, looking perhaps to re-enter FedEx when the numbers make sense for him. I just want to bring you Nike results, which just crossed on the Bloomberg terminal. We have Nike third quarter earnings per share, 77 cents for the period. That's compared with 79 cents a year earlier. So that is a decline, which was expected. The gross margin for the third quarter was 44.8%. That is lighter than what analysts had been anticipating, which was 45.1%. Revenue, top line for Nike, $12.43 billion, higher than the consensus estimate of $12.3 billion. So somewhat higher. You could definitely say it meets it. Inventory for the third quarter, $7.73 billion. Analysts were looking for $8.16 billion. And of course, Nike is certainly a play on China, one of its fastest growing markets. Greater China revenue for the period was $2.08 billion, beating the average analyst estimate of $2.04 billion by just a hair. Let's unpack the results with John Edwards III. He is the team leader for U.S. consumer news for Bloomberg. So, John, when you look at these numbers, does it tell a story of a company that's achieving a turnaround?
It seems like they are on the way, at least. So it looks like the market is trying to decide what it thinks of it so far. But it does look like some of these are positive metrics relative to expectations. Some of the analyst expectations were a little off because some analysts incorporated some charges and some didn't. So the revenue figure we know does compare with estimates, and that they did beat on that. So it looks like again, China moving in the right direction there. And perhaps the cost cutting that they announced last quarter is starting to take hold and help them out a bit.
When it comes to China, how much control does it really have over what's happening there? It's definitely feeling the pain from an overall slowdown in demand for premium brands, especially for American brands, because there's a bit of like patriotic shopping in China. But can Nike really do anything to change that trajectory, or it just has to be patient?
I think it's a combination of sort of patience and looking for their spots where they can hit them. So they are definitely sort of marketing actively there, trying to do what they can to appeal to that, Chinese consumer who is, very difficult these days to appeal to. But at the same time, yes, a lot of, like many companies, they are sort of at the mercy of these broader forces that are, buffeting China along with everyone else.
So Nike has a big cost-cutting program in place. They announced job cuts. They're simplifying their product lineup as well. Do you see that in terms of the inventory numbers here, with inventory at $7.73 billion when analysts were looking for $8.16 billion?
So that's a positive sign that inventories have come down somewhat, and so that's what people have been looking for, and so it does look like they are managing that situation a little better than they had been. So
Jordans, is that it's within Nike, but it's stealing some of Nike's market share. That's what Zach Waring was telling us earlier. Zach Waring, of course, with CFRA. Isn't that going to be a concern going forward? I mean, it's a boost now, but it can't last.
Well, I don't know how much of a concern it really is for the company. I mean, they are happy to see Jordan doing well. They don't want to they don't want to cannibalize too much of their Nike business, but at this moment, it's sort of rising tide lifting all boats there. So they're not. I don't think it's a concern.
Okay, it won't be until it is.
Right.
John Edwards, thank you so much. Team leader for consumer news here at Bloomberg. Again, Nike shares moving higher in the after-hours trade after its third quarter revenue beat the average analyst estimate, $12.43 billion for the quarter. Analysts were looking for $12.3. All right, that does it for Nike's results, at least for now. We're going to discuss the evolution of athletic endorsements in the sports world, which is something Nike has obviously been a leader on. We're going to speak with Eric Smallwood. He is president of Apex Marketing Group. That's next. This is The Close. are still unpacking those Nike results. We can tell you that the shares are moving higher in after-hours trading after the revenue for the third quarter beat analyst estimates as the cost-cutting program certainly continues, and Nike has streamlined its product selection so that it offers more simplicity to consumers. Nike also, of course, dominates in partnerships for the NCAA basketball tournaments. According to Apex Marketing Group, Nike has 42 deals this year, 6 of which come from the Jordan brand alone. Under Armour's 16 deals tops Adidas, which has 7 fewer deals compared to last year. So joining us now to broaden things out is Eric Smallwood, president of Apex Marketing Group. Eric, it's always great to speak with you. When it comes to basketball, we know that basketball is Nike's top sport. And I was just looking at it sounds like Nike sponsors 62% of this year's teams, which includes every 1 to 3 seed. That is pretty remarkable. It is like the default sponsor for the NCAA tournament. At some point, wouldn't viewers or fans take notice if a player is actually sponsored by another brand rather than Nike? They're just kind of used to seeing Nike there.
Absolutely. I mean, Nike's controlled NCAA sports, not only in the basketball space, but football, women's basketball, and other athletic sport, Olympic sports. And they, as you can see from the various numbers that are out, 42 of the teams are Nike. All the top number ones are either Nike or Jumpman. And Jumpman or Jordan brand falls underneath the Nike deals. These are long-term deals with the universities, multi-million-dollar deals. Uniforms are included. And in some cases, Jumpman has been rolled out in those existing Nike relationships.
Does the Jumpman brand, the Jordan brand, cannibalize the Nike brand overall? I mean, does it steal from Nike?
I don't think it does. I think in the younger population really doesn't. They see Jumpman as an independent brand, but it's an extension of the brand. It's a Mountain Dew of Pepsi. It's all they're all the same family. So it's got to help with the bottom line of Nike. It extends the brand, and then Nike can activate on that too, and really push out the Jumpman merchandise and promotions.
So for your clients, what's the distinction of deciding to sign between the Jumpman or Nike overall, or is that a decision that Nike makes for them?
I think with the universities, those universities are working with Nike. Nike rolled it out with UNC and Michigan initially, were some of the first. They also saw an NBA team with Charlotte, because Michael Jordan had part ownership at the time,
right?
Where the Jumpman rolled out, but didn't roll out with the other NBA teams.
I've got to ask you about Nike and golf too, because Tiger Woods, of course, leaving Nike. What happened there? Did they just not offer him enough money, or as an established brand, they couldn't offer him equity the way that TaylorMade could?
I think it's a combination. I mean, TaylorMade offered Tiger a part ownership in his brand. If you go back to 2017, TaylorMade was actually part of Adidas, and then there was a sell-off of the brand. And Nike had gotten out of the golf clubs and golf ball business in 2016, so Tiger was under Nike's agreement with his apparel, but started playing with TaylorMade in 2017 with his clubs. So it was a transitional for Tiger.
Yeah.
It is very interesting to see a existing brand like this, a legacy brand, switch with Tiger going to a new brand.
Yeah, it feels like that was the beginning of the end when he switched over with his golf clubs and the golf balls. I want to also bring in international football, soccer, to us Americans. Nike beat out Adidas to sponsor Germany's national football team for the next 10 years. That feels like a really big coup. Talk about the market potential here of Nike sponsoring entire teams in international football.
Well, if you look at the 22 World Cup, Nike had 13 teams out of the 32. So 40% of the teams were Nike. Adidas had 7, with Germany being in that group. So you fast forward, the interesting thing about it is the timing of this. 2027, when Nike takes over for Adidas and the German national team, the 26 World Cup, which happens in the U.S., will already have happened. So they're going to be playing for the 2030 World Cup. And then they'll get two World Cups under the cycle of their agreement, Nike and national team with Germany.
And what about in the rest of European football, for instance, the Premier League in the UK or in Germany, the Bundesliga, excuse me?
And the Premier League in Germany, Bundesliga, it right now it has, as of 2023, Nike has 6 of the 18 teams at 33% of the teams. So they own the lion's share of the kits in that league as well.
All right, Eric Smallwood, appreciate your joining us today. Eric Smallwood is president of Apex Marketing Group. We're looking at Nike shares moving higher in the after-hours trading. Coming up, we've got the top 3, where we focus in on the top 3 movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. Time now for the top 3. Every day at this time, we take a deep dive into the people at the center of today's most talked about stories. And first up is Nelson Peltz. He's gaining the support of a number of business leaders in his bid to join the Disney board. Institutional Shareholder Services, an influential shareholder advisory firm, has supported Peltz in its recent report. Of course, we know that the vote for board candidates is due next month. Next up is Rob Lynch, the Papa John's CEO, leaving the pizza company to join Shake Shack. The burger chain is looking to expand internationally and rebuild sales and profits after taking a bit of a hit during the pandemic. And finally, the third person we're watching is Shohei Ohtani. The LA Dodgers fired the baseball superstar's interpreter after questions arose about at least $4.5 million in wire transfers sent from Ohtani's bank account to a bookmaking operation. This bookmaking operation is reportedly under federal investigation. All of this as the Dodgers open the MLB season in Seoul, South Korea against the San Diego Padres. So, of course, we needed to bring in our business of sports expert, Jason Kelly, Bloomberg Original's chief correspondent. Jason, this feels huge, especially because MLB is really, really pinning its hopes on revival in the sport on Shohei Ohtani.
Absolutely. They are in the business of Shohei, no doubt. And obviously he's playing for this iconic franchise. I think there's a lot more to come in this story because we're getting all these conflicting reports. You read our reporting, you read, ESPN and others who are writing about this. It's very unclear. Obviously, part of it is because it's happening on the other side of the world. And so, or at least that's where the main players are. The reality that comes through in all of the reporting is not that this was bound to happen, but no one is totally shocked that somehow gambling is really coming front and center in sports betting. We societally and certainly from a big league perspective have embraced sports betting. And this was bound to, not to be too nihilistic, but this was bound to happen. We were going to have some of this. I think people are shocked clearly that it is happening with by far the biggest star in the sport.
Absolutely. A collision between pro athletes and sports gambling was always in the cards, especially because of the way that it's advertised to fans at the games. Everywhere you go, it's around us. So I guess it's not a surprise that it finally did happen, though, again, we don't know all the details yet.
We don't know exactly who's involved. What we do know is there is this federal investigation, and at least one of the biggest stars is somehow tangentially involved, or at least his money is.
Absolutely. Well, speaking of MLB stars, you and one Alex Rodriguez sat down recently with Derek Jeter. Just putting your names together in that context gets me all excited. This is in the latest episode of The Deal, the long-awaited episode of The Deal. Let's take a listen.
How do you think about investing? Does investing excite you? Are you someone that picks up the phone and calls a Michael or calls Passat or one of your friends? Do you share ideas? How do you think about investing when opportunities come your way? Because there's going to be viewers that are going to say, I would love to have my hero, Derek Jeter, invest in my company. I'm a young founder. How do you think about that? How do people approach you? How do they find you?
Yeah, I think one of the benefits and perks of playing in New York is you get a chance to meet a lot of people. I've met a lot of people throughout my careers. I still get a chance to meet a lot of people. The way I look at it, Alex, is I invest in people. You run into people all the time that have great ideas. Everyone has a great idea. Everyone has a business, going to be a billion-dollar business. But you have to invest in people, and you have to get to know them, and you have to know if they're passionate about what they're doing. Some people have businesses where they're in it to make money. Look, we all want to make money. But if that's your number one priority, if you're not passionate about it, then I think that's a red flag. So I always like to invest in people. I think that works for, works in clubhouses and it works in businesses. It works in investments. So I tend to just lean towards the character and the passion of the people.
Derek Jeter there speaking with Jason Kelly and Alex Rodriguez on the deal. What kind of investments has Derek Jeter made? Because he's been very busy with the sport of baseball itself.
Exactly. So he was really locked in on, being the CEO and a minority owner of the Miami Marlins. Since then, he has expanded his repertoire a little bit since he left that job. He's doing some venture investing. He's invested in a collectibles company, for instance. He's pretty selective and pretty measured, which we all appreciate about the captain. I mean, that's how he played the game.
Remarkably consistent, yeah.
He is unbelievably even-keeled, and I think I got the sense through this conversation and other conversations I've had, with him and around him, he's taking his time, he's figuring it out. This is the next chapter, and so watch this space.
Watch this space. Also watch the episode because they dig into their shared history and, some of the tensions that arose when A-Rod first joined the New York Yankees and he had to move to third base. I also have to ask you about the NCAA basketball season because March Madness is upon us and you have been instrumental from the start in raising money for good causes through the brackets.
Yep. So this is Brackets for a Cause. Our chairman, Peter Grauer, sort of oversees all of this and we help him out to do it. We're super excited this year. We have a record number of participants and record size pool, 58 people pledging $20,000 a piece. So these are big checks from big people. So we will have a little less than $1.2 million split between the winners of the men's bracket and the women's bracket evenly. And it's super fun to watch. I will tell you, this will come as no surprise to you. The folks we have, whether it's Goldman Sachs CEO David Solomon or, former Macy's CEO Terry Lundgren, or Steve Pagliuca, the owner of the Boston Celtics. They're pretty competitive, Scar. They're super into this. John Gray, who won a couple years ago, is notably doing the math to figure out, where he's going to end up. So a lot of excitement. We've already had an upset, this afternoon. And so we'll see how the bracketology all unfolds. But a lot of money will go to some good causes. We know that.
Is it a science? Is it an art? Is it just random? Nobody knows.
Nobody knows. It's all of the above. And listen, we have a great story in the Bloomberg today written by Giles Turner, who he talked to a lot of the people in this contest about how they do it. And everybody has a team and sometimes it's their kids, sometimes it's a high school friend in John Gray's case, he won a couple years ago, and sometimes it's analysts who literally, they do a bottoms-up analysis. The private equity guys approach it differently than the hedge fund guys, so
fascinating.
It's fascinating.
All right, Jason Kelly, who do you have for as your winner?
And this is not just sucking up to our chairman, I have UNC.
UNC. All right, we'll see. Jason Kelly of Bloomberg Originals. And of course, you can check out the full episode of The Deal with Derek Jeter tomorrow at 7 p.m. Eastern Time on Bloomberg Television, or you can stream it tonight at 9 on Bloomberg Originals. As we were just talking about, March Madness upon us, and according to Bloomberg Intelligence, sports betting on the tournament expected to see a big boost this year. So let's dig into bracketology right now with Tim Chartier. He is a professor of mathematics and computer science at Davidson College. Tim, so good to speak with you. You just heard Jason talk about how these big titans of Wall Street all have different ways of approaching filling out their brackets. When it comes down to it, though, as much work as anyone or anyone's team does, there's never been a perfect bracket, right?
No, there never has. And part of it has to do with the number of brackets that are possible. It's 9 quintillion if you just look at the number of brackets. And that's just a gigantic number. That's like me picking 1 second in 297 billion years, and you have to pick out the second. And so part of it's just the mere, massive size of the number of options that you have for a tournament. The other part is the fact that there's just so much randomness in the way that 18 to 22-year-olds are going to play under a lot of pressure.
Which is why so many people, including myself, I've been doing this for years, where I just end up choosing the higher-seeded team regardless. How far would you get if you were to only pick the higher-seeded team in every match?
You do pretty well in a lot of tournaments, but you almost never will win a bracket pool doing that. And so it kind of depends on your goal. Is that in the work I do, we're usually trying to pick up some of the upsets, but even today, we didn't get them all. We had Michigan State, I've said that one on media throughout the week. but then we didn't get, we had BYU winning. So it is just part of the nature of doing it, and it makes a lot of studying data science fun and accessible to people.
Absolutely. Now, when you're looking for Cinderella teams, not just an upset, but a team to really, an underdog to continue moving forward, is there a science to finding the matchup that will yield the upset?
There is, and part of it has to do with how teams play on the road and if they can beat strong teams on the road. And it also has to do how they're playing as they move along in the season. Sometimes the teams that are Cinderella teams took a little while to gel as a team, and you can pick that up in the data.
You can pick that up in the data. Now, you teach March Madness in your math classes, which I find remarkable. You've got an independent study that examines data analytics in the context of March Madness. And I believe you told me that you have students who have moved on to work for sports franchises, doing some of the Moneyball work that we've seen. What's the risk, you think, that these jobs will at some point be replaced by AI, especially since this is heavy number crunching and there's an element of randomness to it?
There's probably an element where some of it will be replaced by AI, but one of the biggest parts of sports analytics is communicating to the coaches, customizing it for the coaches, and enabling them to make actionable decisions off of the data. Maybe AI can do that, but generally that takes a human element to actually think through the nuance of that type of communication.
I see. So you're presenting different options to a human being who's then going to perhaps use their gut or something more behavioral based to make a final decision.
Yes, because everything you do in sports analytics is a model. So the person making the decision needs to understand the boundaries of the model so that they can decide, I don't think that this model that they use really applies here. And that's part of the gut that goes with it. That is very important in coaching.
So, Tim, you've been studying bracketology. Have you ever won a tournament?
Ironically, I often don't enter pools. I spend so much time on the media that I don't, but my students have definitely won various pools that they're part of.
All right, who do you have as the winner, by the way?
I do have UConn, although I was pleased to hear Jason pick UNC.
Okay, and your final four, it's UConn, Purdue, Arizona, and Nebraska. Really appreciate it. Tim Chartier of Davidson College, an expert on bracketology. This is what he studies, and this is what he teaches his students. All right, let's take a look at how markets closed on the day. There were record highs across the board here, at least for the S&P 500, the S&P 500 equal weighted index, as well as the NASDAQ 100 as well. You can see yields moving lower there on the 10-year down to 4.2669%, so backing away from that 4.35% level that a lot of people had highlighted as being instrumental for turning against stocks. The Bloomberg Dollar Index moving higher by 0.4%. A lot of central bank action this week. The Swiss National Bank unexpectedly cutting interest rates for one, and crude oil, a source of inflation, declining today, off by 0.5%. This is the close. Let's turn now to the auto sector. The White House has issued a new rule limiting vehicle pollution. It's designed to ensure that the majority of new passenger cars and light trucks sold in the U.S. are all electric or hybrids by 2032. So joining us now is Craig Keeys. He is Group Vice President at Infiniti Americas, which means that he's responsible for overseeing the Infiniti brand in the U.S., Canada, Mexico, Latin America, Caribbean, and Israel markets. Craig, good to see you.
Great to see you as well, Scarlett. Thank you.
So I wanted to start with this new White House issued regulation. The point of it, as we mentioned, is to ensure that most new vehicles are EVs or hybrids by 2032. We've seen how demand for electric vehicles has really slowed down the last couple of years. There's been price cuts from a number of manufacturers. Do you think we'll get there?
That's a great question. Thank you. I think we're wrestling with the speed of adoption.
Yeah.
And so I think the pace is going to continue to be dynamic. And I think companies are going to have to respond in kind. And whether it's full electrification or moving to hybrid as part of the powertrain evolution, the thing we have to consider are cost.
Yeah.
And can we get there efficiently and effectively? And so I think ultimately the electrified evolution is a real thing, and we will get there eventually. But for me, it's really about the speed of adoption.
Okay, so do you think rules like this will result in more choices or fewer choices for consumers over the next 8 years?
I think it's TBD. Ultimately, for Infiniti, we want to keep a balanced proportion of both EVs and ICE vehicles. And so by the time we get to 2030, 40% of our lineup will be electrified, but we'll still have some ICE options for the consumer. So I think it'll ultimately be about choice.
When you talk to consumers, how big a priority are limited fuel emissions today versus a couple years ago?
I think it depends on the segment, firstly, and I think it depends on the individual client needs.
For those who purchase Infiniti?
For those who purchase Infiniti today, I think they are centered on performance and a slight combination of efficiency. But in the FSUV segment, where we launched our QX80, it's really all about performance, convenience, and comfort.
Okay. What does that look like in terms of the focus on fuel emissions, limited fuel emissions, when it comes to regional markets? California, for instance, Texas, or the Northeast or the Southeast?
Absolutely. I think the small states have shown us that's where the adoption has happened first. I think also it's shown us that's where the infrastructure investment has happened as well. And I think that's part of the formula as to where you'll see the movement, i.e. California, for example. And so I think we do have to consider what our powertrain evolution ultimately looks like and pace ourselves. But I do think that there's a balance to be struck based on consumer choice today.
Okay, you talk about evolution, pacing yourself. Electrification is definitely part of Infiniti's long-term strategy.
It is.
How exactly do hybrids fit into that strategy? Are they a means to the end of full EV, or are they increasingly the preferred destination?
I think you're seeing some velocity on hybrids today, but eventually I believe that EVs are the ultimate future. Again, I go back to the speed of adoption. For us, we're betting on a combination of EVs. Last October at the Japan Mobility Show, we announced and confirmed 2 EVs, a Vision QE concept sedan, and also an SUV concept as well. And within that, as I mentioned, we'll also have ICE vehicles still available.
Okay, when it comes to performance, compare and contrast EVs and hybrids for me from a value standpoint.
From a value standpoint, I think both have their options, and especially when you think about EVs and the rebates you get as a corporation, and also the incentives under IRA for the consumer. So I think there's a definite financial benefit there. As far as performance, I think you've seen more torque, more power out of these EVs, but at the same time, we're pulling more power out of our ICE engines. For example, we're moving from a V8 engine in the QX80 to a V6 twin turbo that's actually providing more horsepower and more torque.
And of course, the QX80 is the new luxury SUV that you're unveiling today, or at least a 2025 model of that. When I look at Infiniti's current lineup, I see 1 sedan and 4 SUV/crossover vehicles. Does demand for these bigger vehicles, these SUVs, these crossovers, outpace sedans 4-to-1?
Well, the ratio wouldn't be that exact because the large majority of our volume does come from our SUVs, but not necessarily in that proportion. What I would tell you is in the F segment, there is a deep desire for our products embedded with technology, comfort, convenience, as I mentioned earlier, and it's really about lifestyle for Infiniti clients and the experience that they get when they are in our vehicles.
When I look at your vehicles as well, true market value, I look at Edmond's data, and it shows Lexus vehicles have really held their value. We have a chart actually that shows this. While if you look at Infiniti vehicles, they've come under some pressure in the last couple of years. What do you attribute that to, that divergence?
Well, I think one of the things that I can attribute it to is just the volatility in the used car market. That ultimately impacts our remarketing efforts and our residual values. And that's been a big component of the decline. But what I will tell you is today, because we're doing a lot less fleet is only 1% of our business, We're keeping our cars out of auction and moving them through our retailers as our primary outlet. That'll continue to help to improve and stabilize those numbers.
Okay, stabilize and perhaps get to a point where they'll hold their value or maybe even increase their value. I mean, that would be an ideal situation.
That would be ideal.
Talk to me a little bit about the cost cutting that consumers are feeling on their end as they look for a new car and the incorporation of cost cuts that Infiniti needs to make given the increased cost of materials.
Yeah, that's a real thing. Thank you for pointing that out. I would also say that there are a ton of pressures on our clients as far as interest rates, and so affordability is certainly a question. But when you are operating in the luxury commodity space, there is a bit of inelastic demand, and those consumers, while they may pause or take an optimistically cautious approach, they get back to spending and ultimately buy what they need. And I think that is where Infiniti has some strength.
Craig, thank you for joining us today.
Thank you, Scarlett. Thanks for having me. I appreciate it.
Vice President at Infiniti Americas.
Thank you.
Now, still ahead, what investors need to watch for in tomorrow's trade. This is The Close. Record highs in the stock market today after the Federal Reserve signaled that it will continue to move forward or forecast 3 interest rate cuts for this year. Let's take a look at what's on the calendar for tomorrow. We're going to start with what's happening in Europe. You've got an EU leaders summit continuing into a second day. After we get you the headlines from that, we're going to move out. You know what? We have the headline here coming out right now. Apparently 16 U.S. states have filed a suit against the White House for the halt on new LNG, liquefied natural gas licenses. Of course, President Biden back in January halted the approval of these new licenses to export U.S. LNG in order to scrutinize how these shipments might affect climate change. And now you have 16 U.S. states filing a suit against the White House for that action. We will we'll give you more details in the next hour on balance of power. And of course, look ahead to what that means, not just for the economy, but for the effort to transition to green energy and what it means for billions of dollars that are currently in process, that are pending at the moment here. That does it for us right now. Balance of Power will take over with more of those headlines. Have a great evening, everyone. This is The Close on Bloomberg.